In Jonathan Golub, he is Chief U.S. Equity Strategist at Credit Suisse. It's good to see you. Welcome to the program. I'll just start where Bob sort of teed you up, which right off the conversation we're having now about technology. Is 23 going to be better or the same?
Well, I'm not as overly optimistic on these names, but for a very different reason than you folks are laying out, because I don't think this is simply a sentiment story and a valuation story and a discount rate story with interest rates higher. These companies have delivered terrible earnings this year. What you had was, during the pandemic, a lot of these companies, and I wouldn't call it an EV car company part of that group, but a lot of the tech companies pulled forward a huge amount of earnings activity. And the same thing with companies that did at-home exercise equipment and things of that nature. And then what we did is we made the mistake of extrapolating that growth almost forever. And then when the economy opened up and we were able to go and move away from buying goods back to enjoying life, the earnings disappointed. The earnings picture revisions have been lower. The estimates go lower, and then they're missing the lowered estimates. The growth rates have been terrible on these names. This is the worst earnings environment for tech-related companies since the iPhone came out in 2008.
What's the earnings environment more broadly going to look like in 2023? Because that's going to dictate what stocks do. You're optimistic, but not, wholeheartedly. 40-50 is your target for the S&P. Obviously higher than where we are now, but not looking for a gangbusters year.
Right. So there's a lot of movement and rotation. So what are the big stories? The first one is that with inflation coming off, and that's a positive thing, and that's what the market's expecting. But it's bad for corporate revenues, because a lot of the reason that revenues have been so strong in the last year and a half is because simply you're paying more per unit rather than selling more units. But then you have a lot of expected rotation within the groups. The market is expecting a bounce in tech earnings in the next 12 months. And I think it's going to take longer. This pull forward of activity of us buying, whether it's a new laptop or whatever, or a streaming service, I think it's not going to be 3 or 4 quarters of weak earnings, which we've seen, but I think it could be 6 or 8. So I think we're going to see weaker tech than is expected next year. So I think this is going to drag out a little bit longer. I don't think valuations they're a little bit rich still, but they're not a problem. On the other hand, energy stocks are expected to go from a blockbuster year in earnings to something much weaker. That's consensus expectations. I think the market has it wrong. I think the energy companies are going to surprise. The revisions have been higher recently than any other sector, even though the oil prices are coming down. So I think that there's going to be a number of big surprises on areas that are expected to reverse that are going to keep trending.
Jonathan, I want to talk about your estimates for 2023. You have a year-end price target of 40.60 on the S&P, so that would be up about 5% or so from here. Your earnings look a little lower at 215. Now, the street this year was 220, 230 for next year, so you're a little bit lower. You think earnings are going to be down next year, so slightly higher on the price, slightly lower on the earnings, so that means the multiple's a little higher. Right? I mean, where are you on this? And you're sort of right in the middle from what I can see of most of the strategies.
Yeah. So first, our earnings, our market target is 40-50, and that's kind of an uninspiring, like a 5% return for next year, which is really historically weak. But I think the story here is that inflation is going to come down much more than I think the average investor realizes. The TIPS break-evens are saying that we'll have about 2% inflation by the end of next year, from a peak of over 9%. And economists' forecasts are basically corroborating that. But what's weird about it is it's not overall inflation that's falling. It's goods inflation because of all this at-home buying that we did, which set up weird comps. Services are expected to stay really pricey, whether that's hotel or an airfare or something like that. Wages expected to stay sticky. So it's interesting. A lot of companies are going to be stuck with higher wages and losing pricing power. So we think it's going to be a little bit of a more difficult environment. However, the consumer is going to be really resilient. Think about this. They're going to be getting a raise, and the stuff they're buying is going to be coming down in price. and jobs are plentiful, consumers are going to continue to spend money. That's going to keep the recession further in the future, whether that's very late 23 or early 24. And that's going to be the reason that multiples edge not a ton, but a little bit higher, even though the earnings are a little bit soft.